Hello friends, last week in my video, I suggested that a falling Indian rupee versus the dollar and spiking bond yields on the Indian 10-year benchmark bond yields were a lethal combination that bulls would watch very keenly. And sure enough, look at what happened last week. Bond yields continued to rise and the rupee weakened against the dollar. Now, there is a fresh worry. Should you worry about it? And I am talking about rising crude oil prices, which are raising the specter of inflation all over again. And will the bulls take due notice of that? We are going to take a market data related, statistical data related outlook and see what lies in store for us. So let's dive right in. And on your screen right now is the market roundup window, which tells me that the bank Nifty fell harder and faster compared to the Nifty 50 yet again. Obviously, inflation worries banks more than anything else. And in the coming week, there is the RBI Monetary Policy Committee meeting outcome that will determine which way interest rates are going in India. The US dollar index or the Dixie continued to rise and the Indian rupee continued to fall against the dollar. A rising US dollar exerted downward pressure on silver and natural gas, whereas crude oil rose because Russia and Saudi Arabia extended their output cuts, and therefore this is a man-made shortage which is being extended even further. Gold rose a tad on a week-on-week basis. The Indian 10-year benchmark bond yield rose to 7.20%. That means bond prices fell. Another reason why the banking stocks felt the heat. NSE market capitalization managed to rise 0.01%, all thanks to the delivery-based small cap and mid cap stocks which continued to outperform the broader markets. Market-wide position limits MWPL rose routinely after expiry, and the US indices fell across the board, thereby providing headwinds to our domestic markets. I now come to the in-house studies which basically tell us which way the winds are blowing. I start with the MWPL, and MWPL shows a smart rise in the week after expiry to 34.60%. This is the highest in 5 expiries that we have seen in the chart, in this 20-week chart. This is the highest in the post-expiry week that we've seen in the last 5 months, and that tells you that both the bulls and the bears are raising their stakes, and this is likely to lead to higher volatility because whichever side loses will square up a large amount of outstanding open interest and lead to bigger price swings. So brace up for higher volatility. Conviction is not lacking. Both sides are throwing bigger money into their trades. I now come to the index and stock future indices. Remember, these are 3 concurrent series: August, September, and October. Last week, I told you that the sharp spike in the indices was thanks to the expiry, which results in dual turnover. And sure enough, post-expiry, the volumes have fallen along expected lines, and we need to see whether one Marshmallow traders are picking up the gauntlet in the week ahead and how far volumes do tend to go higher. I now come to the NSE advanced decline ratio. This is an average of all 5 trading sessions of the week. After the price itself, the advanced decline ratio is the best leading indicator of which way the winds are blowing. Now, advanced decline ratio improved slightly to 1.25 from the prior week's 1.03, which means for every 100 shares falling, there were 125 shares rising. It is better than what we saw in the prior week, even though the Nifty fell 0.66%, which is a bigger decline than the week prior. So there was cushioning coming in at lower levels, and should this advanced decline ratio stay above 1 with rising prices, bulls can come back. I now come to the Nifty and Bank Nifty prompt futures basis. Now, what is basis? It is the premium or discount prevalent in the future compared to spot prices. Last week, I told you that such sharp rallies in the basis, such sharp spikes are unlikely to sustain. And sure enough, you see the basis almost halved in the bank nifty, whereas the nifty also saw almost commensurate decline. Now, this suggests that there was bull unwinding at higher levels, and also basis tends to contract along with the passage of time, just like your options premium has a time decay. As long as the basis is positive, which means futures are trading above spot, which is above zero here on this chart, I think bulls will continue to cushion declines by short covering on lower levels. Watch the basis. I update this chart every day on my social media accounts, particularly on my Telegram channel. So please do subscribe to our free channel here. I now come to our exclusive in-house indicator, the impetus, which you've been following for almost 2 years now, and you've trusted it, you've traded on it. And what we are seeing is a divergence between the impetus readings of the two indices. The red line is the bank nifty impetus, which seems to have risen last week. The blue line is the nifty impetus, which has fallen marginally. Even though both indices fell, the rise in the bank nifty impetus tells me that there was greater force in the sell-off in the bank nifty, which means there is nervousness. Now, part of this could be the RBI policy meeting, which is likely to announce interest rates on the 10th of August. So, traders are nervous, but the fact remains that the bank nifty is showing greater relative weakness as compared to the nifty 50. So let's be careful out there. I now come to another exclusive in-house indicator, the LWTD, the lift weight thrust drag index, which you've been liking for 6 quarters now. And what we are seeing is that the nifty has fallen even more sharper as compared to the prior week. And the LWTD reading is now come down to below zero. It is now at minus 0.08, which means that there is likely to be lighter fresh buying support on declines in the week ahead. Now, this is a very major week because of the RBI policy meeting. So, this is likely to be a very light trade kind of a scenario. So, we should follow suit as well. Friends, the in-house indicators done. I now come to the bond markets, which have let loose a storm of fury. Do remember that we have been talking about bond market indicators for banking sector traders far ahead of what the others have been assigning weightage to this neglected segment. Note on the weekly chart on your screen how for the second consecutive week Indian 10-year benchmark bond yields have risen. We are now at almost a 4-month high. Now, this is exactly the reason why I have been telling you on our Telegram channel that I am not in a hurry to write out checks to gilt funds, because I don't think interest rates have peaked out as yet. The rising interest rates in the US by the Federal Reserve by a quarter percentage point, and a similar rise in the Bank of England interest rates are telling me that sporadic rate hikes are still likely to continue. You think it is central banks that determine interest rates and they do this to curb inflation. I have a different take on this situation altogether. It is big money that writes out big checks, that moves the needles and gauges in the markets, and these guys want and will get higher interest rates, and it is only after they have parked sufficient amount of money locked in for a long enough period of time in long tenure bonds that they will allow interest rates to fall. So let's not be in a hurry to go in for laddering of sovereign yields at this point in time, nor jump into gilt funds prematurely. I have received feedback from a couple of my viewers from my online family. Hey Vijay, we've already parked money into gilt funds. Now what do we do? I would say don't panic. Whatever allocation you have given, it's not that you're going to go into negative. You're not going to lose your capital just because you bought gilt funds, because interest rates at some point in time will peak out. It's just that you have been premature in buying gilt funds. So you have no other option, unfortunately, than to hold on to what you've already done in haste. Friends, the bond market done. I now come to the bank nifty, which has witnessed the brunt of the selling and fallen more than the Nifty 50. And the daily chart on your screen tells you how this index has surrendered 1.29% on a week-on-week basis and fallen out on 3 out of 5 trading sessions. The declining days were a lot more prominent as compared to the rising days. Note how the red color candles are bigger and with gaps as compared to the green color candles. The price is below a month-long moving average, which means even the short-term outlook has turned marginally nervous because bulls who have bought recently are now nursing a mark-to-market loss. If they've carried over their long positions from the previous settlement, then they are in a bigger problem because they would have incurred a cost of carry which is not showing on the charts. This is why your charts do not give you a total picture of what's happening in the market. Now the 44,152 level is the immediate support to watch out for. Should this support be violated on a sustained closing basis, near-term traders, short-term traders might be a little more panicky. Coming to the weekly chart on your screen, it becomes apparent why the 44,152 level is important. It's a previous swing high. And note how we have seen the last 2 candles which are consecutively bearish, and in the prior week we had seen a bearish piercing pattern which is now confirmed as a bearish indicator because last week's candle low has violated the fortnight ago bullish candle low by a clear margin. Now, unless you go above 46,500 levels, which is an immediate swing high, bulls are likely to remain somewhat under pressure. The price is above its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So the medium-term outlook still remains positive as of now, but the short-term outlook is cloudy. Do remember, it's an RBI announcement week. And also remember what I have been telling you and writing in my live mint columns, that the banking and financial sector space commands a 37.59% weightage in the Nifty itself. So whichever way the banks and financial sector services go, that way they will drag or push the markets respectively. I have been basically warning you on detailed free Telegram posts about how rising costs of funds is a very major concern for the markets. Friends, in the week before last, this index was at number 6 on our in-house statistical beta list of most volatile counters that we maintain. Last week, it rose 2 notches to reach number 4. Which means volatility and the challenge to intraday players rose. Last week, I advocated an estimated range between 46,400 on the upside and 44,325 on the downside, which was admittedly violated by 46 points because the intra-week low was 44,279. And in the coming week, I estimate a range between 46,025 on the upside and 43,750 on the downside. Let's be careful out there. Like I said, it's a news-heavy week. Friends, I now come to the Nifty 50, which fell like the Bank Nifty on 3 out of 5 trading sessions, but it only fell 0.66%. Which is a little over half of what the Bank Nifty fell in percentage terms. Now, here again on the daily chart on your screen, you will see that the declining days are a lot more prominent on the Nifty 50 as compared to the rallying days. And The price is precariously poised at the month-long moving average, which means the near-term outlook is a little touch and go. It's not as weak as the Bank Nifty in relative comparative terms. The 18,887 is a previous swing high, which I've marked as a blue line. And coming to the weekly chart, you're seeing why the 18,887 line is important. It's a previous significant high and a swing high as well. So that will provide support on the downsides. The price is above its a 25-week exponential moving average, which is a 6-month long holding on cost. So the medium-term outlook is okay. But to note, a fortnight ago, what you saw was an inverted hammer, Nagareboshi, or a shooting star at a significant high of the ongoing rally at that point in time. And last week I had warned you that the shooting star, which was the second shooting star in a month, would basically be an indicator of which way the markets are going. By itself, it need not be a bearish or a bullish indicator. But if the low of the shooting star is violated on a sustained closing basis, which last week it was, it means that the bears are, at least for the short term, in command. Now, the Nifty must rise above the 20,000 mark to put the bulls in the driver's seat back unequivocally. Now, in the week before last, this index was at number 8 on our most volatile counters list as per statistical beta that we maintain in-house. It slipped 2 notches to number 10. Not because the volatility went down too much, but because individual stock volatility rose higher and faster in relative comparison. Last week, I advocated a range between 20,000 and 25 on the upside and 19,250 on the downside, which held perfectly well. In the coming week, I estimate a range between 19,900 on the upside and 19,125 on the downside. Here again, I would trade light because it's a news-heavy week. Friends, I now come to the last bit of statistical data analysis wherein I estimate the risk appetite prevalent in the market by way of the footprint of the retail traders as to which segment they are trading how much. Now, index futures turnover fell, which you are seeing on the daily chart on your screen as a blue color line, and it fell by 4 basis points. The stock futures turnover, which you are seeing as a red line, has fallen by 32 basis points. The fact that turnover in the futures fell, and futures demand a lot of span margin and mark-to-market margin, they are more volatile than options, tells me that risk appetite was lower. Index options turnover shot up humongously, and I have shown this as an military green color line. The turnover contribution went up by 0.89%. Now, these are cheapest to trade in terms of monetary commitment, and also where volatility is concerned, they are a lot less volatile than stock options. So, index options were back as the leading segment where traders were focusing their attention on, and stock options turnover surrendered 0.53% in contribution to the total turnover, and I've indicated this as a purple line. Net, the indications are that risk appetite was definitely lower, and bulls were taking an approach of extreme caution by betting on the index options, the lowest risk, lowest monetary demanding instrument out there. Unless this product mix or turnover mix rises substantially in the favor of higher risk appetite, I would say that this nervousness due to rising oil prices, the interest rate meeting of the Monetary Policy Committee, and the USD INR along with bond yields will continue to weigh on the mind of an average bull and probably keep them slightly under check. Friends, I now come to the segment where I discuss what I would do in the coming week. The first and foremost thing that I would suggest is cut down your traded exposure, because this week is likely to be somewhat frustrating. There would be an element of wait and watch in the stock market till the RBI announces its decision on Thursday. And public sector banks is something that I have been advocating since the last fortnight, to trade in whichever direction your snapcoat window is taking you. And I have been fairly happy with how large price moves were logged by this segment of the market. And I hope my online family has capitalized on the moves here. Oil drillers will basically continue to do well because oil prices are rising, and I've told you why. This is the hurricane season in the US, and divergence between oil and gas prices is likely to persist because there is this man-made shortage created by Saudi Arabia and Russia. And the Russians are talking about increasing their output cut by a further 300,000 barrels per day. So OPEC output is likely to come down. They are pushing prices higher by creating scarcity in the market. Commodity traders should be careful, and this is something I have told you even last week where options trading is concerned. If you are an option writer, you're betting on theta decay. Note how the crude oil prices are not allowing option premium to really decay as fast as you would. And I saw at least one high strike price open up for trade where there was no turnover earlier. This tells me that option writers are now running towards the safety of deeply out of money strike prices because they are witnessing a sense of threat perception from rising prices. That's basically a defensive outlook. And this can also worry bulls because inflation concerns will return back with a vengeance. I will watch the RBI announcement before taking a call on laddering sovereign yields or even going in for gilt funds. So let's be careful out there. The market belongs to the patient person who writes a check at the right time. Friends, I now come to the most popular segment of the market for a statistically inclined trader, wherein I give you 5 stocks that have gained the most amount of impetus on Friday. So you take small exposure, wait for large price moves, and 5 stocks that have lost the most amount of impetus on Friday, where you take big exposure and wait for small price moves. This is for scalpers. Note that this list is valid only for Monday. Tuesday through Friday, I update it on our free Telegram channel. So do take the effort of subscribing there. Now, the impetus gainers list is led by Laurus Labs, followed by Vedanta, Bajaj Finserv, Jubilant Foods, and Voltas. Impetus losers list is led by Reliance, followed by Hindustan Unilever, Infosys, AU Bank, and Persistent Systems. Friends, how did you like this video? How do you like our work? We would love to hear from you in the comment segment. And before I sign off from this video, a reminder to subscribe to our channel if you haven't already done so, and click on the bell icon to receive instant alerts about fresh videos being put up out here. Hey, help me reach out to a larger audience by sharing my video with smart traders like yourselves in your social media groups and your friends and family. I thank you for your patience in being with me in this video and wish you a very profitable week ahead. This is Vijay Bhambwani signing off for now till we meet in my next. Do take very good care of your trades. Thank you and bye-bye.